Hello everyone, welcome back to the Road to Retiring channel. I hope you're doing well. Today I received an email from TipRanks which was for this article, which as you can see, TipRanks Perfect 10 list, 2 top stocks that analysts are placing their bets on. Now I thought it would be a good idea today to have a look at these 2 stocks, what I think their values are and if they're worth buying. So if you enjoy this kind of content, please do drop the video a like, subscribe and let me know in the comments down below any other stocks you're interested in hearing my thoughts on. So to get started with this, let's read through it. We can see the last 2 weeks have seen the markets take a roller coaster ride, and the insolvency and failure of Silicon Valley Bank and the federal closures of Signature and Silvergate banks have triggered worries of an old-fashioned bank run. Now, on top of this, they're saying it's a confusing situation, which is one tailor-made for intuitive data parsing tool, and the Smart Score at TipRanks is a good useful tool which does just that, and they're saying the AI-powered data collection takes in all this information across all the stocks and can use this information to present an easy to use scale from 1 to 10 on whether these stocks are a good stock to buy now, and a high Smart Score can't guarantee that a stock will beat the market, but it does give investors a strong clue towards positive performance, and the perfect 10 stocks are always worth a closer look. So in terms of this, they're saying using this platform, they've pinpointed 2 stocks that have the enviable perfect 10 Smart Score, with each also featuring a strong buy rating from analyst consensus and a double-digit upside potential for the coming year. So they're saying it's got all of these really good perfect indicators for strong performance coming, and the first one of these is ARRY Technologies. Now here you go, ARRY Technologies are in the solar energy industry. With ARRY Technologies, this company specializes in solar tracker technology, and as you can see, their flagship product, the DuraTrack system, is used in large-scale solar power projects, the types connected to public power generation utilities, and is considered a leading system in the solar tracker field. So there might be that competitive advantage from them being a leading system, which is good to see. And they start to speak a bit about the earnings, but we're going to go through this in a bit more detail here. So to start off with, let's have a look at the history of it. Now, looking at ARRY Technologies, which we have open here, it's not got a lot of history. We can see it the price chart only starts in 2021, not been on the market a massive amount of time. Looking at the income statement down here, in terms of quarterly, the profit margins are growing really nicely, as you can see from the orange line. But without that historical performance on impressive growth rates, I find it hard to have a low margin of safety with this. It's all about managing risk with investments. And to do this, I want to see that a company has historical performance in growing certain metrics like earnings and revenue. And this just isn't the case with ARRY, as they've only been in the market since 2020. There's not that long history of impressive growth rates. We're going to have a high margin of safety with this. Also, not a massive market cap, as you can see here, only 2.56 billion as a market cap. So it's barely above a small cap stock. So yeah, definitely a high margin of safety needed. On top of this, if we look at the current investment and management of the company, and we look at the return on invested capital, the management don't seem to be making the best decisions. In terms of 2021, this was at minus 8.21%. Though quarterly it has started to rise, it's currently at minus 0.73%. Hopefully we start to see that move into the positives. Above 10% is where I feel comfortable with the decisions and thinking that the management is making smart and effective decisions. But obviously with the earnings currently being quite low, this is why return on invested capital isn't at a high percentage. And hopefully, as I say, as they move more towards profitability, as you can see the annual projection of it is doing so, then we will see that return on invested capital increase. Now, additionally to this, I want to see that they're not going to be in financial trouble when I'm looking at the risk. So when I have a look at their long-term debt, I see 700 million compared to a free cash flow of minus 62 million. And if we look at their cash and their financial health down here, you can see their debt is at 726 million, and they do have a decent portion of cash at 67 million, sorry. Now this is in 2021, so it's updated a bit, and I'll show you 2022. But right now, that's not a fantastic position to be in terms of the debt compared to their free cash flow and cash. And additionally to this, the long-term financial position analysis does not paint a good picture. You can see liabilities over double the size of their long-term assets. So in terms of financial health, It's not something I'm super comfortable with. You can see the current free cash flow is at minus 62 million, so it isn't as bad as it was in 2021 over the trailing 12 months. But that long-term debt is still sitting around the same level, around 725 million currently in the last quarter. And in terms of their cash on hand, you can see cash and short-term investments and cash and equivalents. This was 367 million in 2021, but quarterly big drop into 2022, which is currently only at 62 million. So their cash has come down a lot. So there's a lot of risk involved with this. However, if they are able to mitigate these risks, if they're able to perform to the standards that we're seeing here from the analysts with large earnings growth and large revenue growth, then we will see values that are quite decent. So I've put a 45% earnings growth rate in, and based on that, it would be a price of earnings fair value of $12. It's currently trading at 17 with a 2027 price of 27. Now that doesn't sound great, but this is only half the earnings growth rate that the analysts are expecting, because typically analysts are about 100% ambitious on average. Now I've gone for a really high margin of safety, and I've also gone for some quite high share dilution at 5%. If we look at their total common shares outstanding, you can see this has increased quite quickly from 126 million in 2022, where it currently sits at 150 million right now. So up 30 million shares in just 2 years. They are diluting these shares. No, they're not buying back shares at the rates we'd like to see. They're actually issuing more shares. So I put 5% share dilution. Now we have 45% growth. That gives us a fair value of 12. But if we were to see what the analysts are projecting at 89.3, then it's completely different. If we put 89% earnings growth in, suddenly the fair value becomes $45, and the 2027 price is at $102.51. So you have to really manage your risk here. And as I say, because of just how difficult this could be to reach 89% earnings growth, and because of the risk involved here, I just don't feel comfortable at those levels. I've gone for 45 with a price earnings multiple sort of in line with their sector median, because with a stock like this, I want to be really comfortable going into it, and 45% still doesn't seem super comfortable to me. But at those levels, yeah, it's $12. Looking at the price of sales, this is a bit easier to look at, as we don't have to think just from when they were profitable in terms of the price to earnings. Price to sales, they've been having these metric available for a while compared to price to earnings. If you look, price to earnings literally was only available in 2020, whereas price to sales has been for a few years now, from 6.2 in 2020 to where it currently sits at 1.8. We look at it quarterly, you can see this has been coming down quite a lot. Did start to rise again in Q3 of 2022, but we can base our price to sales ratio a bit easier on this. So I'm going to go for 1.75. I'm projecting this growth rate from 1.6 billion in 2022 to 2.5 billion in 2025, which is what we have here. 1.6 billion to 2.5 billion in 2025, a 17% revenue growth rate, and a price to sales multiple of 1.75. Then that brings the price to a value of $14.16 as a fair value, and a 2027 price of $31.85. So there's great growth from the $17 levels in current market price to that $31.85 mark in 2027. But because of how much risk I think could be involved with this, we just want to be super careful with this sort of investment. And personally, I don't think it's one I'd go into because of how much risk is involved. But if you are someone who likes to play a bit more risky gambles, then the fair value is 14. That's sort of where I'd be a little bit more interested in getting into this. And now on top of this, again, I've gone for a price over operating cash flow multiple, sort of in line with the sector median. Operational cash flow growth, bringing the operational cash flow a little bit above net income in 2027 to account for things like depreciation and amortization. And that brings a fair value based on the cash flow of $10.19 with a $22.91 fair value in 2027. Now, as I say, these could all be so much higher. If we do see that 80% growth in earnings, then you'd be looking at something similar in operational cash flow growth, and suddenly it becomes a great buy and one you should invest in. But you have to be really confident that the analysts' growth estimates are actually accurate and they're going to meet that 89%, and I'm just I can't commit to knowing that they're going to be accurate at those levels because it just seems so ambitious. And taking all of that into account, that brings the average fair value of ARRY Technologies to around $12.15 with an average 2027 price of $27.34. So based on that, there's still a 9.87% return on investment each year, which is pretty good. But as I say, you just have to be super careful with a stock like this, and you have to make sure that there's a lot of upside involved if you are going to invest, because you can't be, for a stock to only have 9.87% returns, which is pretty much in line with the market, then you would like that to be a really safe stock, one that you know has got great chance of this occurring. And in terms of a stock like this, I just want much higher returns. I'd want to be so much more careful with a stock like this, so that's why I've gone for these estimates. Now to look at the next stock, we scroll down a little, you can see the next stock is Argenx SE, or ARGX, ARGX. I said that terribly, I was trying to read it and say it at the same time, but yeah, it's the second perfect 10 stock we'll look at. Is Argenx, a biopharma firm in the immunology niche, working on new treatments for rare diseases. Has an extensive pipeline with nearly 20 separate research tracks investigating the uses and efficacy of 3 different drug candidates. It's the leading candidate it has is, I'm not going to kill another name, has received approval in the US, Europe and Japan, the treatment of rare neuromuscular disease GMG, and the company was focused in 2022 on launch activities for the medication branded as Vyvgart. In its 2022 annual report, you can see it gave updated information on this launch, and there are 3,000 GMG patients on this, and the drug generated a full year net product revenue of 400 million. So it is starting to turn over sales at quite an aggressive rate, and when I show you the estimates for sales for this one, they are absolutely crazy. So again, there's a 10 rating on this, strong buy, but let's have a look at it ourselves. So looking at ARGX, this is one that's actually quite expensive already. It's $359.67 per share, and you can see there's a bit more data available here going back to 2017, and historically this has been growing at a really nice rate. The profit margins are a bit all over the place, especially if you look annually. You can see they're jumping up and down, and also this has always been in the negatives, which isn't great to see, but they are hoping to become profitable in 2025 and then really aggressively grow those earnings from 2026 onwards. What I think is really interesting is the sales outlook for this company. If you look here, you can see from 2015 they've actually grown quite a lot to current levels, from 10 million in revenue in 2015 to 445 million in revenue in 2022, but the projection is just absolutely crazy, flying all the way up to 3.5 billion in 2026. Crazy projections, but again, we need to look at managing the risk. In terms of the historical growth of the company, it's only really there for revenue, which we can see that impressive growth. The revenue, yeah, that's grown great from 2015 to 2022. But if we look at earnings, obviously that's not growing how we'd like to see. If we look at operational cash flow, again, it's not growing in the way we'd like to see it, from 11 million in 2016 to currently minus 850 million in 2022. But equity actually is seriously impressive with this company. They have 3.13 billion in assets and just 300 million in total liabilities. An absolutely crazy amount of assets over liabilities. If we look at the financial health down here, you can see they have 846 million in cash to that minus 850 million in free cash flow, but their debt is really low at just 12 million. So if they could start to turn that free cash flow around, it would start to become really interesting. And just looking at the financial position analysis, I don't think I've ever seen a graph quite like this, with the assets towering above the liabilities. 2.7 billion in short-term assets compared to 300 million in liabilities, and in 360 million long-term assets compared to just 18 million long-term liabilities. An absolutely crazy amount more assets and liabilities, which is really comfy and healthy to see, but they just don't have that historic growth rate we'd like. And if we look at the price to sales ratio, it's so high. I've never really seen a price to sales ratio as high as this. 126 in 2018, shot all the way up to 320 in 2020. and currently 2022 is trading at a 50 price to sales. Now an average price to sales for their sector is around 4, so 50 is super high. I think the valuation for this might be a little bit out of hand. You can see currently it's at 67.43, the sector median's at 3.92. This is 1,600% higher than the average sector level, and when I start to look at the valuation of this, it just seems a bit high for myself personally. Looking at ARGX here, I can't obviously project the earnings in the way I'd want to, because you can't put earnings growth on a negative EPS. So I've had to put in what is expected in 2026. So the EPS of $23.16 is what is projected here. You can see $23.16 in 2026 earnings estimate. I put that in, and based on that, with a price over earnings multiple of 25, which is above the sector median, but I think there'll still be a premium, that brings a fair value of $579 in 2026, which would mean the current fair value is around 281, because again, we have to apply high share dilution, high margin of safety, because they're not in the best position in terms of historical growth. The earnings are falling, the cash flow is falling, the return on invested capital obviously is going to be in the negatives because they are obviously not profitable. You can see it's at minus 26%. There's just a lot of risk involved with a stock like this, so I've gone for, again, a high margin of safety because I just don't feel super confident with a company that's not profitable yet. And yeah, high share dilution, because if we look at their total common shares outstanding, they've gone from 20 million in 2016 all the way up to 55 million, nearly tripling the amount of shares outstanding in just 6 years, which is, to be honest, I've been on the nice side with the 5% share dilution, because that's only taking the share count 67.44 in 2026. Now if we look at how it has grown from 2016 to 2022, only increase to 67 would actually be quite nice to see. This could easily be way higher. Now, based on that earnings estimate and a price of earnings multiple of 25, then yeah, we're looking at a fair value of around $281.92. Now, we could easily see this price to earnings multiple, the PREG ratio, be closer to 1, which would mean that this would be in line with earnings growth, and then it becomes below the fair value. Then the fair value is $394, and the returns would be fantastic with a 2027 price of $1,042. So there's definitely a lot of potential upside here, but again, we just have to manage the risk with a company like this, as it doesn't have that historical growth that we can look at and see to know that they are performing consistently. So we just have to manage this risk, and if we do go into a company like this, we want to make sure we're getting it at what could potentially be a massive bargain level. So in terms of price to sales, here again it's slightly easier because they weren't profitable in terms of price to earnings. We can treat price to sales more how we would typically. So we've gone for 67.5% revenue growth, which sounds absolutely crazy, but that is what's projected. If we look at the earnings annually, revenue going from 445 million in 2022 to 3.5 billion in 2026. So that's what we've projected here, with that 445 million revenue in 2022 to 3.5 billion revenue in 2026. We've gone for a price to sales multiple of 8. Now this is around double the sector median, but I do think there'll be a premium with this sort of stock. But as I said, the price to sales currently is just super uncomfortable. There's no way it's going to stay at those levels for any significant period of time. So I've gone for 8, and that would bring a fair value of $294.76 with a 2027 price of $662.89. So again, if we do see these growth rates, that 2027 price is fantastic returns, almost double what the current price is now. But in terms of the risk involved with a company like this, we have to have the high margin of safety, because are they going to be able to meet 67.5% revenue growth? That is a very, very ambitious projection, and they could easily not meet those levels, and then we need to apply that margin of safety in case they do not hit those levels. And lastly, operational cash flow. Again, because it's currently negative, we can't put the growth rates in the same way we would for price over earnings. So similarly to the earnings growth, we couldn't project the cash flow growth rate in the same way that we have done in price to sales, because it is not profitable at the moment, and so a cash flow growth rate of 10% is just going to increase it further into the negatives. So we couldn't put in a growth rate, we had to go based on the estimate, and so I put operational cash flow slightly above the levels we're expecting for net income when you take into account things like depreciation, amortization. That brings us a fair value in 2026 of $593.15 when using a price over operating cash flow multiple of 20. Again, I expect that slight premium, but not to the levels we're currently seeing. And that would bring a 2026 price of $593.15. So with this one, yes, there is a lot of potential upside. There'll be a 13% return on your investment annually at the current levels, which is obviously really, really great. But I do think with a stock like this, you just really want to manage your risk. You want to make sure that you're getting it at a super bargain level where the risk becomes worth it. And for me, that would be a bit more of a discount, maybe about a 20% drop lower. $288 is where I would consider it because of the risk involved. Now, it could easily meet these prices and then it looks like a great investment, but it could just as easily not meet these prices and completely fall away, as there is so much risk involved. So got to make sure you're managing your risk efficiently with these sort of investments. And so that's my take on these two perfect 10 TipRanks stocks. I think they definitely have potential for a super high upside, but again, there's so much risk involved with these that I just want them to come down a little bit more before I would personally consider them. And I typically like stocks that are a little bit safer at a value. So if these are the sort of stocks that interest you, let me know, and let me know why you like going into these kind of stocks. If you did enjoy the video, please do drop it a like, subscribe, and let me know in the comments any other stocks that you'd like to see me talk about. For now, it's been Road to Retiring. Bye guys.